So it is interesting that you're back. I mean, you settled with the company more than a year ago, right? You got your couple of board seats. You got them to make some changes. And why are you back?
Well, unfortunately, the stock hasn't performed well. The business hasn't performed well. And 2 directors just wasn't enough change. We really tried to work constructively a year ago when we entered the settlement. The company and the board, told us and other shareholders that everything was working wonderfully well. They had the business fixed and they were on the right track. If you read our letter, you can see there are many quotes from Michelle and the rest of the team about how well things were going. And if you look now, a year later, it's another wasted year. Sales dramatically underperformed the sector, whether it's on mall or off mall or specialty or big box. All forms of retail, they underperformed. Their sales aren't even growing versus 2019. Most of the industry is up 20% versus 2019. They're negative to 2019. While their EBITDA has grown, again, it still lagged the entire sector. Stock trades at one of the worst valuations. It trades cheaper than it did during COVID and the Great Recession at 2.7 times EBITDA. And, a year ago, Scott, you might remember they would say, oh, we're doing better than the department stores like Macy's and Dillard's. They can't even make that claim. Macy's is up 130%. Dillard's is up 300%. Unfortunately, it looks like, though we had some people in the boardroom, it wasn't nearly enough change, and a lot more change is required if shareholders are going to be able to generate returns here. I'm trying
to wonder, what sort of more substantive change do you need to happen other than faces in a boardroom? I mean, they reinstated the dividend. They increased the buyback. They've invested in the brands that they have, like Sephora. And I'm wondering, how is it possibly enough time, a year, let's just call it a year, how is that possibly enough time to allow a retailer who's made some of the changes that you first demanded, and I'll use the word demanded because that's really what you did, to see them through, especially at a time when you're coming out of a pandemic?
Scott, it's a fair question. I think it might be helpful to just pull the lens back a little bit. This is a company that's unfortunately been failing for a very long time. If we look back to the greatness agenda that they launched in 2014, they missed all the objectives they were trying to accomplish then. If you look back to what they set forth in 2019, they missed all those objectives. So it's not like this is a new phenomenon, like they just started missing numbers. This has been going on for decades. In fact, 2 decades. The stock price is below where it was 20 years ago. So it's not new, and it's not new that hope springs eternal at Kohl's. There's always another new initiative. There's always something else they're working on. There's another shiny object that they're going to chase that's going to, drive sales in the next period. It used to be Amazon. It used to be Pop Sugar. Now it's going to be Sephora. And unfortunately, the core merchandise assortment and the value proposition is broken, and it needs help, and it needs to be fixed immediately. Otherwise, the company is going to continue to lose market share year in and year out. And look, buying stock back is great. We've recommended doing a major sale leaseback and buying more stock back. But at the end of the day, they have to fix the core operations of this business. That's where they're underperforming. That's where they're losing market share.
So, I mean, I have your letter, obviously here in front of me, in which you do mention another wasted year. You do take issue as well with the company's shift into athleisure, sort of throwing cold water on that plan when last quarter growth in that segment was up 25%. Now, I'm no retailing expert, but 25% growth in a quarter sounds pretty good.
Yeah. Again, it's important that the whole store grows, right? We've seen this, you might remember all I focus on is retail, and this is a phenomenon we see year in and year out with failing retailers. They'll pick one part of the assortment and they'll commit a lot of inventory to that part of the assortment. And yes, if you double your inventory commitment to that part of the assortment, it has the potential to grow. But the problem is you're not growing the whole pie. Same-store sales, comp store sales are still negative versus 2019. And despite having some growth in that area where they've committed a significant amount of inventory dollars, they've not had growth in other areas or not even maintained those other businesses. So where athleisure might have gone up, other parts of the business went down. And I think we say it in the letter, what's interesting is we believe these things are kind of fashion trends, right? It's a 90, 100,000 square foot box. They have to be able to serve all parts of the day, all parts of a person's life, evening, daytime, weekends, work. And to say we're going to be an athleisure company, is not a sustainable strategy for a company that big that caters to such a wide audience. So as they're maybe growing athleisure, they're losing share in maybe dress up. And as we came out of the pandemic, people were sick of wearing sweatpants. And you know, they wanted more in the assortment that Kohl's didn't have, unfortunately. And you see it. You see what Dillard's has done. Their sales are up remarkably, up 30%. Macy's are up, you know, high teens, 20%. Every other company's assortment is resonating much more with the customer than Kohl's assortment, despite maybe having a little success. Every retailer has some successes and some failures. But until the whole pie grows, it's hard to call it a success.